Joe, what's on your mind?
Treacherous, that's the word. The environment of today is an awful environment. It's an awful environment for an investor. It's an awful environment for anyone that's trying to trade this market. The last couple of days, yes, there were opportunities as it relates to trading. There are certainly opportunities for long-term investors who do not believe that what the future will look like is going to look like something we saw in the 2000s when we had a lost decade. But what we are seeing today, when you have that 7% swing, when you've had the deleveraging that you've had over the last several days, what happens after that deleveraging? A lot of hedge funds, a lot of institutional speculators, they step to the sidelines. And what you're greeted with is a type of a market environment where you have today where you think you potentially get an all-clear signal, and then you're just whipsawing all over the place. So what do you do in that environment? I think you really have to study how much risk you have in equities and bonds and the totality of your portfolio. And if you're beyond the boundaries of where your comfort level is, I think you have to retreat on that because you cannot have strong conviction about either direction right now, given this treacherous environment.
All right. Tom Lee, we got Tariff Liberation Day wrong. Yeah, you did. We want to apologize, as the terms of Tariff Liberation Day were far worse than we expected. Morgan Stanley, be prepared for another 7 to 8% potential downside. Krinsky's talking about the 200-week moving average. That's 46.74 as being major support. Mike, I'm curious. You've seen so many markets, and you've seen a lot of volatile markets over the course of your career. What do you make of this one and the way that we've had this price action today?
I think a lot of those folks who are trying to use whatever process to come up with some kind of structural, maybe we've done enough to the downside, it does settle out not too far below where the overnight futures were, like kind of 46, 47, 4,800. And that kind of takes you back to the beginning of 2022. And I think it is very relevant that we haven't seen this kind of intraday action since early 2020, because it is that kind of complete disjunction. Right? It was essentially the market was trying to handicap, a process. The process was completely thrown off by an off-the-charts, basically interruption in the world economy, and that's what happened in 2020. And then what you're left with is trying to figure out if we're getting to a level of being washed out to where it doesn't matter what the news is. We had the latest post from the president, people saying, wow, the market took it well. Then he said another 50% on China. Well, one, that's a preposterous number. The market recognizes that once you're getting up to these levels, it doesn't matter. But also, he said, negotiations are happening with other countries. Do we care? Do we not care? Is it just the market reacting to itself right now?
Do we even believe it?
Right,
because you get the narrative of the two sides of the story. Not negotiable, negotiable. He's going to negotiate. These aren't negotiating things. I mean, is it for revenue?
You have the billionaire backlash. That's new this week. You have this idea that maybe there'll be legal challenges to it. I think that there's a migration in sort of the center of opinion of how this might go out and how urgent the issue is. To me, I'm just watching the market and saying, looks like the equity futures made a triple bottom overnight. Use that as your downside kind of mental floor for the moment. It's like 48.50-ish. But I mean, it's so tenuous. And when the market's moving like this, I always say it has to just go really far to find anybody with conviction. And that's why you get, this type of twitchy action.
Pasquarello, Goldman Sachs, the fundamental backdrop has undeniably worsened, he says. Remember, he's the one a week ago was like preservation of capital, people. That's what this is about, that the game has changed. He follows it up with this most recent note. While the primary trend is now lower, I also think you have to be aware of the increased probability of indiscriminate short cycle rips. It's a feature, not an oddity, of when you have the S&P do this sort of thing. I expect the S&P will cut a broad pattern of gap down, gap up over the next few weeks. And the final point he reiterates, his view, preservation of capital, still the principal objective. My trading instinct, and it's nothing more than that, he says, is that next week brings some form of a de-escalation. You've had the headline that the market moved on. We're looking, Brian, for any signs of light. As many people I talked to yesterday, late into the night, were thinking that there's got to be some sort of pivot coming at some point because this is untenable, that they don't understand the damage that they are causing. If $11 trillion wiped out of stocks in a very short period of time doesn't ring the alarm bells, then something ultimately is going to do that. I'm frankly struck by the fact that you suggest today that you are staying the course that you have 6,700 for the year on the S&P. I have countless targets taken down, more again today, 5,600, 5,200, 5,950 from various strategists respectively there. Why are you staying the course?
Well, first of all, we're excessively fortunate to be here today. We've had this opportunity over our career to be on this network during days like this, and I can't be more humble for that, number one. Number two, Joe used the term treacherous. I would say unfortunate. It's very unfortunate what's happening here because I don't think it is anything with respect to fundamentals. And as you know, we're a fundamental investor. I can't speak to other people's process or discipline, Scott, in terms of how they look at targets. I know that how we do. And my team and I spent the weekend writing 2 reports, one for the U.S. and one for Canada, as is our duties as the chief strategist at Piper. I'm sorry, Piper, at BMO. At the end of the day, it is excessively rare to have this type of activity 2 days in a row. It's not rare to see a Friday type of sell-off into the weekend and have the exacerbated bottom that Mike is talking about on a Monday. In fact, on Monday, March 20th, you and I were on the Markets in Turmoil show after the market closed on COVID. And at that day, I said the markets were going to rally up 50%. And so I'm not being flippant. I'm not being stubbornly bullish. I believe in what the market is telling us historically. And since 1950, when you have these types of moves in these successive days, 12 months out, the market's up 29%. Now, does that mean that we're not going to see these exacerbated moves on a short-term basis? Nobody can predict those. Nobody can time those. But what we can predict is the fundamental backdrop. Longer term, near term, yes, we have some damage here, and we will assess that and assess our target once we know where the bottom is and when we begin to recover from that.
Okay. I want to take issue with one thing that you said.
Yep.
Aside from the confusing where you currently work, but that's neither here nor there. That's for you to reconcile, not me.
Better hope you still work there.
You make the claim that this is not due to fundamentals. I would make the argument that it is everything to do with fundamentals. Mm-hmm. Forget about the technical trading of levels here and there, averages, blah, blah, blah. This is obviously about the market sensing a recession and trying to right price itself for the recession that many now see as a higher probability. Many firms are obviously taking up their expectations of that. If you think that earnings are going to have to come down, which they will in a recession, and that the multiple will have to come down, which it will, then that is purely based on fundamental trading, not on anything else. That's what the market's trying to go through. Don't you agree?
Okay, so stocks lead earnings, which lead the economy. The stock market's telling you that we're probably going to have some sort of a slowdown and or a recession. Remember, when the recession, the Fed comes in and pumps in liquidity. The Fed pumps in liquidity. What are we going to do? We're going to buy stocks. So I think at some point we are going to have some sort of slowdown and the earnings are going to go down. We'll adjust our targets when we start to see some substantive proof of that.
What do you mean? You don't?
No, hold on a second. What's happening? Do you think that this rhetoric and change in tune and fake news and tariff stuff, do you think that has anything to do with how companies are going to be earning their money or how they're looking at going forward, how to model their company? How can they change on a daily or weekly basis when we don't know what we don't know?
You're telling me that companies haven't already changed their expectations for the kind of business and spending and investment that they're going to do? They all have.
Do you think
they all have?
Do you think the membership process in Costco has changed? Do you believe the way that the operating system runs Apple has changed? Do you believe that the internet machine at Google has changed? Do you believe that how Netflix and the way that they run their business has changed? No, the answer is no. Now, how they model that, how they grow that, how they operate that, yes, we know that, and that is going to change. And we will change our numbers accordingly when we see those real numbers, Scott. So I think from a longer-term perspective, we are investors. We're not going to react to today or last week or what Trump's going to say in 30 seconds. We don't know that because that's not fundamental. What Trump is saying is not fundamental with respect to his reaction, and how we're reacting is not fundamental.